known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And what we're going to talk about is going to be a really good video for traders or people that really want to understand the market and how to kind of look at the market in the world from a different perspective and put yourself in a position to make money from what's going on in the world. So we're going to look at this from a macro standpoint, and we're going to go to a micro standpoint. But I really want to start giving you a different way of looking at things that are going on in the economy, instead of looking at it from a reactionary standpoint, instead of looking at it from a victim standpoint. Try to look at it from the standpoint of how can you and your group put yourself in a position to where you can benefit from it, right? Unless you choose to try to go on a crusade to stop it. If not, how can you benefit from it? So let's go ahead and go into it. So here's an article from the Wall Street Journal. And this is one of the reasons why I really encourage traders to read market-based publications every day. And one of the reasons why we do this is because once you start reading a lot of the market-based publications, it starts training you to look at the world differently, because what you don't get is a lot of the victimization. You don't get a lot of the political polarization. You don't get a lot of the woe is me type commentary that is created by a lot of the mainstream networks and also created by the people on social media. You get information that's designed to give you an understanding of what's going on in the economy, what's going on in the markets, and then you can take that information and try to go make some money. So in the Wall Street Journal, there's an article about credit card debt keeps falling and why the banks are on edge. And what this article goes into to kind of really, wrap it up without me going into the details is that Discover, Capital One, Synchrony Financial, some of the largest issuers of credit cards are dealing with an issue is that because of so much liquidity in the economy and a lot of the stimulus, but also a lot of the unemployment going to consumers, they were able to pay off their credit card debt. So looking at this particular graph, you're seeing that, we had this amount of total outstanding credit card debt around 2020, and we're seeing that it's gone down. Now, it's not down to zero, but you're seeing a massive decrease. Now, we understand that the credit card companies make their money off the interest fees of the debt. So the consumer paying off the debt is bad for their business. Their job is to get you into that particular compound interest formula and to just keep you in that formula indefinitely. And the longer you stay with that balance on your credit card, the more money they make off of you. So when a lot of people start paying off their debt and paying their credit card balances down and essentially sometimes closing their credit card balance off, that is bad for their business, but especially is bad for their bottom line, because banks only make money by selling money. They don't make money any other way. They have to sell you money at interest to be able to show their investors, this is how much money we made last year in fees and things of that nature. They also do some transaction fees, but the majority of their money comes from selling money to other people in the form of debt. So here's a really good article about this being a problem for them, right? And what were some of the reasons why this took place, yada, 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 and how they were going to have to try to figure this particular problem out to continue to show to their customers, right, that they were not customers, to their investors, or essentially their owners, that they were worth investing. And when you're looking at this particular article, all of these are publicly traded companies. So American Express is publicly traded, and you can tell because you see that their stock ticker. Now, today they're up for a reason that we're going to go into a little bit later. So see JP Morgan Chase, Equifax, which is a reporting agency. We got Wells Fargo. You also have Synchrony, Capital One, and Discover. So we talked about, again, when you're reading these financial publications like the Wall Street Journal, they not only give you the name of the business, but they also give you the stock ticker, and they also give you their position during that particular day when the market is operating. So currently right now, the market is open. So this is their current position. Now, it's not going to be up to the minute, but this is pretty much their position in the market at this current time, along with their ticker. So now if you want to go look and find the ticker for Discover Financial Services, you already know what it is DFS. Now, we want to understand something. The economy that we live in America is a debt economy. It's based on debt. The average American consumer cannot exist without debt. Now, a lot of people are going to tell you that credit is good, debt is good, yada, yada, yada. I understand they're selling a product, right, based around educating people on how to leverage credit. But I want you to understand something. The average American cannot exist without consumer credit. The average American cannot go to college and pay with cash. They don't have it. The average American cannot buy a car with cash. They don't have the cash. The average American cannot buy a house with cash. They don't have the cash. So they have to leverage debt to live the life that they want to live. So then they have to develop a relationship with these financial institutions, right? And so therefore, you keep this cycle of debt going on pretty much your whole life. And that's how they've built this economy. So you can go to other parts of the world where this is not their reality. So they don't have this issue of being in debt to a bank the majority of their life, right? They don't have to develop these type of relationships with these banking institutions. So the banks have such a strong footprint in America, but especially in the West, because of the infrastructure that they've built, is that it's very difficult for most Americans to go through their life without having a relationship with one of these financial institutions, right? Because like I said, most people can't go to college without getting a loan, right? Then when it's time to buy a car, most people can't buy a brand new car without getting some type of financing. They don't have the money. Most people cannot buy a house without getting some type of financing. They don't have the money, right? And then as inflation goes up, it becomes more and more expensive to buy these things. So it means what? You now have to finance it, because you really definitely can't buy it with cash because of inflation. So as the price of things goes up, but your actual income stays flat or actually goes down, you now have to go to these financial institutions to get access to their credit or get access to their credit lines to purchase these consumer items that you want, right? Because of the state of the economy. So their position becomes more and more entrenched. So this is one of the challenges that they had. So in reading this, you'll want to ask yourself, how are they going to overcome this particular challenge? Because their investors want to see quarterly that they're increasing their bottom line. They're essentially selling more loans. So how are they going to deal with this particular challenge? Now, this article came out on May 11th, 2021. So then as we continue to read, because we read this publication on a regular basis, we notice this article. So this article states that JP Morgan and others plan to issue credit cards of people with no credit scores, right? So then the narrative that they're trying to create is that regulators had asked banks how to make loans from people who have been locked out from getting them. Now, what a lot of these people don't understand is that if you've been locked out from a credit card, right, it may be the best thing that ever happened to you, because you would have to try to figure out, how can I operate my life without credit? Now, like I said, I know the narrative on a lot of people on social media is that, you want credit, yada, yada, yada. You need to ask yourself, do you need the amount of consumer credit that you currently have? What is it doing for you? Because if all it's doing for you is helping you buy consumer items, the question you want to ask yourself is, why do you need consumer items? Right? So you're not getting consumer credit to purchase like medicine. So if you're getting consumer credit to purchase consumer items, if that's your justification, but if that's what you want, I'm cool with that. But we need to start asking ourselves these questions when we have these relationships with these financial institutions. Is why do we need their credit? What are we buying with it? Are we buying food and medicine, or are we buying something else that we may not necessarily need, but we just want? But our desire for this is so strong, we have to keep the relationship with them. And so that's how they stay in position. So then this article goes in the fact that JP Morgan Chase, Wells Fargo, US Bank Corp, we see their ticker. We also see their stock position, right? They're going to start looking at the bank account of the particular person that may not have a credit card, right? And start maybe looking at a borrowing history or cash flows going into that account. Because what they're trying to do is figure out, how can we sell more debt? Why? Because that's the only way they make money. And then they also talk about that these banks, if you read this article, are going to share data amongst each other. So instead of them taking their internal data and keeping that private to them, what they're going to do is share data with each other. But we also know they're going to share data to the credit reporting agencies. OK, so we're in a situation now to where, because so many people was able to kind of get a foothold financially because of stimulus, because of unemployment, and they were smart to pay a lot of their debt off. A lot of the financial institutions now have to come up with a new way to sell more debt. So let's find people that traditionally, right, didn't have credit cards, maybe were unbanked, and figure out, is there a program that we can create to sell them more debt, right? And then what we're going to do is we're going to present it as that we're offering banking services to people that were normally underserved, but they're not offering real banking services, right? They're just selling you consumer debt. If you go to these people and ask them, can you get a home loan? You may have a challenge. If you go to them and ask them, can you get a business loan? They're probably going to tell you no, but they will sell you consumer debt, right? But then as a trader, what you want to do is look at these particular companies that they're talking about it, right? So we talked about it being, Wells Fargo, JP Morgan Chase, Bancorp. Now, one of the things I like about a lot of the bank stocks, their volume normally is very high over the course of the day. And a lot of times the option market is very, very liquid. And what I mean by very, very liquid is that they have a lot of open interest. They have a lot of volume on their contracts. And as a result, their premiums are really not that expensive because of the amount of volume. So if you really, really start to understand how banks actually make their money, their relationship with the Federal Reserve, you can understand what they're going to have to do to make money, because we're living in a situation now to where the housing market has really been cooked up really hard. It's really been ramped up, right? So they've kind of peaked that out. Now they're going to try to go into the consumer credit market, and they're going to try to ramp that up. They try to make even more money because of the massive amount of liquidity that's been pumped into the particular economy by the Federal Reserve. It made money very, very cheap to get access to. So we're kind of going into a repeat of what we had in like 06, 05, 06, 07, where it was so cheap to get credit. Everybody was flush with credit, and then everybody was buying stuff, right? And that worked until it didn't work. And so what we're seeing is that we're almost seeing a repeat of that, but the banks don't have a choice, because that's the only way they can make money is to sell money. So I would really investigate, if I was going to trade banks, pick a basket of banks that you maybe want to look at. How do they really make their money? What's their relationship? How is their particular portfolio structured, right? From a consumer credit standpoint, mortgages, business loans, things of that nature. Can you get information on that? How is their portfolio? How is their balance sheet structured? What are some of their debt obligations, right? What are they doing in revenues? And then try to understand how they actually make their money, as opposed to maybe what somebody on the internet or on social media is telling you how they make their money. Really, really start to understand their business model, and then understand how you can look at what they have going on the macro economy that's going to bleed into this particular micro company, and then put yourself in a position to make money as a trader, right? Because what they're looking to do is try to figure out how to drive new revenue in by opening up new markets, creating new verticals, because of the amount of liquidity in the market that we don't think is going to stop anytime soon. So we're going to continue to have these practices going on over and over again. And, we talked about before, we're kind of seeing a repeat of what we saw around almost 20 years ago, was that there was so much liquidity in the market. Credit was so cheap to get. Everybody had a car. Everybody had rims. Everybody had a brand new house. People had multiple homes. And it was because it was very, very easy to get access to capital from a consumer standpoint. Like I said, you try to get a business loan, it's a totally different conversation. But they will give you that credit line, right? And they will give you access to, car loans and things of that nature. So want to encourage you to start looking at these financial publications, start understanding the macro conversation down to the micro conversation, and start doing research, right? Outside of what a lot of people may be presenting to you through the mainstream news, about how these actual businesses actually work. Like, how do they actually make money? What are their actual goals? What do they actually need to do to operate to be successful? And once you understand that, you can put yourself in a position to piggyback off what they're doing to make you and your group some money. So if you have any questions, hit me up in the comments, reach out to me one-on-one. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world. Talk to you later.